I'm really excited for today's episode because I'm going to talk about one of my favorite companies, Airtable. Now, the reason why I love Airtable is because I use it internally at University Growth Fund all the time. It has been like this massive lifesaver for me. And the reason for that is because University Growth Fund is this like really unique organization where there isn't really like software that solves our needs, right? Like I have all these students coming in, I need to be able to track them. I have deals coming in, I need to be able to assign students to deals. It feels like a good project management solution would be able to solve our problems, but we have like this unique issue where we have high turnover. We don't have a budget to spend tens of thousands of dollars on, crazy complex software. And so I've always had this challenge of trying to like find solutions that are like highly customized to our needs without having to spend a ton of money. And what's been really cool with Airtable is because it's this online relational database that's really easy to use, I've been able to create my own internal software effectively for our organization. And not only have I been able to do this, but over 450,000 customers have been able to use Airtable to create unique solutions for their problems, rather than going out and hiring a dev team to build other products for them. And the platform is super flexible. So you can use it to do all kinds of things. You want to use it for a CRM, you can use it for that. You want to use it for product management or project management, you can use it for that. You can use it as an employee database. You can use it for, forums for collecting data and managing that data. I mean, there's so many different cool things you can do with it. Then you can build dashboards on top of it that allow you to analyze the data in real time. You can do plugins and pull in data. And all of it is done in a no-code or low-code environment where they don't have to rely on being a developer or having a dev team to help them build it. They can just get in and immediately start building their apps. So huge fan of Airtable. I've always loved it. Kicking myself to this day for not investing in the company in the very early days when I first started using it, because I think I must have been like one of the first maybe 1,000 customers, maybe even the first couple hundred, because I've been using it for a really long time. So you can imagine like my excitement when I was perusing the internet the other day and saw that Start Engine is allowing people to invest in the company. Now, this is really cool because a company like Airtable is a really hot commodity. Lots of people want to invest in such a great company. If you look there at their investor base, it's a phenomenal list of investors. Some of my favorites like CRV, which is a very early stage venture fund. People like Michael Dell, the founder of Dell Computers. Large investors like JP Morgan as an investor. So you have a remarkable investor base behind it. It's also one of these hot commodities where historically they've been able to pick and choose who their investors are because they're such a great, well-run company with incredible product-led growth. So the fact that Start Engine was making this opportunity available to the general public. Now, I think you do have to be an accredited investor to invest, but anyways, just making this available, I thought was really interesting, and I wanted to dig in a little bit more and really evaluate this as an investment opportunity. Stick around to the end because what I discovered is there's a big hidden risk just below the surface, and if you get too caught up in Airtable and the brand and the user experience and like the investor base and all of those things, you might miss out on one of the biggest risks that you should definitely take into consideration before making an investment in the company. Okay, so if you look at the data that's available on Start Engine for this investment, there's not a lot that they're able to share. They report that the company did $142 million in revenue in 2022. It has just under 1,000 employees. It's raised $1.35 billion, and that the last round valuation was at a little over $11 billion. Now, those are helpful statistics. They also talk about like some of the investors that I mentioned earlier, really impressive investor group. And look, 142 million in recurring revenue is very strong. Like that is a real company that could definitely go public on those numbers, right? Especially if they're able to continue to grow. Now, ideally, they'd be growing at the rule of 40. So they're at least growing by 40% and keeping their bottom line at break even, which in this environment is what I would expect, knowing nothing more about the company. Now, I don't have any unique insight into how they're doing. There are some rumors that they're growing at roughly 14%, which would be relatively disappointing. But let's say that like this is a very well-run product-led growth company, hitting the rule of 40. My estimation would be, if I were the CEO, I would be trying to push for break even, which means, according to the rule of 40, if you're at break even, you should be growing at about 40% on the top line revenue. So if they're growing at about 40% year over year, that would put year-end revenues for 2023 roughly at about $200 million. Now, that is a very solid company. Like, you want to be somewhere in the $150 to $200 million ARR, annualized recurring revenue. You want to be at about $150 to $200 million of annual recurring revenue in order to go public and have a good debut in good market conditions. So company is like very well positioned to be able to go public. And frankly, like, they fit in so nicely with so many different companies that are out there. You know, you could think about like Google picking them up and rolling it into their Google Drive and Google Apps products, because it feels very similar to like Google Sheets and Google Docs and so forth. So a lot of potential acquirers, very obvious like pathway to exit here. Now, here's the thing that I think is the biggest risk that you have to take into consideration, and that is the valuation that you're buying in at and the security that you're buying. Now, what Start Engine is offering is Series B preferred shares. Now, these are shares that an investor came in and bought when they made an investment in the company back in 2018, when the company was valued at roughly $1.1 billion. And basically what's happening here is it's what's called a secondary transaction, where you are not investing directly in the company, rather you are buying shares from a Series B investor, and you're buying those Series B preferred shares from them. Now, the good news is Series B preferred shares are going to come with a bunch of rights. Now, we don't know exactly what rights were given to the Series B shareholders. There could be all kinds of different things. My guess, though, is that given that the company was valued at $1.1 billion, achieving unicorn status, the terms were probably fairly generous. And this was a really good company. Lots of people are trying to fight to get into. I would expect that the terms on the Series B would be fairly vanilla, that you would get a 1x liquidation preference on your investment, meaning that you would get paid back your investment first before anybody else. Now, the caveat here that you have to remember is that that was for Series B investors. So the company raised about $26 million in that Series B round, which means the Series B investors have a right to be paid back their $26 million before Series A and Series C preferred shares. But typically they will be paid back after the subsequent series of capital have been paid back. So the company went on to raise 3 more rounds of capital, Series C, Series D, Series E. And during that time period raised effectively $1.3 billion, which means the investors that invested in the Series C and the D and the E are going to be paid back their $1.3 billion first before Series B will get paid back anything. This is called the preference stack. What is the stack of capital that gets paid back before you get paid back in a downside scenario? So if the company sells for $1.5 billion, well, the company's only raised $1.35 billion. So in that case, investors would technically be in the money in terms of getting all of their investment back, right? All the investors would get paid back their $1.35 billion, and then the remaining $150 million would be spread amongst whoever else is there. Now, that's not entirely accurate because you have to go through this waterfall of paying back Series E, and then Series D, and then Series C, and then what's left gets spread out, from Series B and A and so on all the way down to Common. Common gets paid back first. They don't have any real liquidation preference. Although I will say, and this is just a quick side caveat, Common has like the ultimate liquidation preference because they could just walk. And so oftentimes what you'll see is a company will say, hey, we'll sell to this company. And even though there won't be any money left for the common shareholders, we're going to have what we call management carve out, where we're going to take a little bit off the top to pay the common, just so that the common sticks around and keeps doing their job long enough for the company to get acquired so that the investors get paid back at least some, if not all of their capital. Anyways, side tangent. You see that happen a lot, though. What I want to talk about, though, is the valuation here. So you do have some downside protection. The question now becomes will this company cross the $1.35 billion valuation threshold such that you at least would get some of your money back? Now, remember, there's only $26 million coming back, and the share price at that point is about $39 per share. What Start Engine is selling is at roughly $95 a share. Your downside protection here is about $40.95. So that's what the Series B preferred share downside protection really offers you. What you want to know, though, is like, that's only if the company gets acquired for at least $1.35 billion, such that there's enough money to pay the Series B shareholders back to therefore give you that $40 back per share. So how do we figure that out? Well, just quick back of the napkin, we could look at some other comparable companies. So if we look at the public market and we look at some companies that are comparable, some obvious ones would be companies like Monday.com and Asana and Salesforce. Now, Monday.com is currently trading for roughly, depending on the day, about 12x enterprise value to revenue. So what that means is enterprise value is basically the value of the entire company. Like if I come in and I wanted to buy and own the entire company, right, that is my enterprise value. And the revenue is revenue. And so a common metric is we take the enterprise value and we divide it by the revenue. That gives us an enterprise value to revenue multiple, which is useful because then we can compare it to other companies that have different revenues to determine how the market might value that company. Because it's a similar company, the revenue is a little bit different. What would the market therefore put as a valuation on the overall business, the enterprise value? And these multiples can be incredibly helpful in trying to get a rough estimate of what your company will be worth someday. So if you look at Monday.com, they're roughly trading at about 12x. If you look at companies like Salesforce, they're trading at about 7.6x. If you look at Asana, they're trading about 6.6x. If you look at Smartsheets, which is another interesting comparable, they're trading at roughly 6x. So you're somewhere between 6 and 12x. Now that's a pretty big range. Usually it boils down to a few things like how profitable are they, how efficient, how good are their margins, how strong is their growth, how sticky is their product, those types of factors. So that's how you could get, Monday.com might be growing really fast compared to Smartsheets, which might not be growing as fast. And then therefore is valued at half the multiple of Monday.com. Nonetheless, let's assume that our multiple range sits somewhere between a 6x and a 12x. Well, on $142 million of revenue, using roughly a 7x, that means the company's worth about $1 billion today. That's even under what the Series B preferred shareholders invested at a $1.1 billion valuation. But, hey, let's give them the benefit of the doubt. Let's assume that they grew last year from $142 million in the end of 2022 to $200 million at the end of this year. Well, that now puts them at a $1.4 billion valuation, which is good because it will mean that they will have covered their liquidation preference stack, right? They've raised $1.35 billion, and based on our multiples and forecasted revenue, they're worth $1.4 billion. So they should be able to pay back all of the investors their invested capital. Now, keep in mind, you would be investing through this at a $95 per share price, and you're protected only at $40. So just because they cover the liquidation preference, all that means is that you're getting 40 cents essentially on the dollar for every dollar you invested in the company. Not really a great return. But, look, investors, we're all about taking risk. We're all about swinging for the fences. Let's talk about maybe the bull case. The bull case here is that Airtable gets valued similarly to Monday.com, so at roughly a 12x multiple. So if we assume that the company grew to $200 million in value this last year, and we give them the benefit of the doubt of a 12x multiple on their valuation, then that would mean they'd be valued at $2.4 billion. Now that's pretty good, except for now we need to go through the waterfall. So right off the bat, $2.4 billion is a lot lower than the $11.7 billion valuation of the last round. In fact, it's also lower than the $5.7 billion valuation, and it's even lower than the $2.59 billion valuation of the Series C round. What that means is that because it's lower than all of those valuations, all of those investors are going to want their money back rather than their ownership percentage of the overall company. So that's roughly $1.3 billion taken right off the top of the table. So if the company sells for $2.4 billion, tomorrow, then that's 1.3 right off the top that's gone. That leaves you with $1.1 billion left. Well, $1.1 billion is the valuation of the Series B round. So they're pretty indifferent between getting their ownership percentage back or getting their capital back. They probably just, they're going to get their capital back. So that's $26 million coming back. That's 40 cents on the dollar coming back to you as an investor in this security. assuming that you invested at $95 a share, right? Because the share price at the Series B was $40 per share, and you're buying in at this investment at a $95 per share price. So what does this mean? This means that like you have to believe that the company is going to grow by quite a bit. It's got to eventually be worth at least what you're paying, which is roughly about a $5 billion valuation today. Now, in order to take this risk, I would really want to see them jump to roughly a $10 billion valuation, so I could at least get roughly a 2x on this investment. Now look, the positive here is the company is probably close to break even. Even if they're not, they probably have most of their $750 million that they raised back in 2021. Let's assume they still have like half of it. That's $350 million. That's a lot of money that they can use to continue to operate and support the business and grow it over time, right? The benefit here is that the company's probably not going to go out of business tomorrow. What it does mean is that it's going to take a while for them to grow into it. So then you really have to believe that the company can achieve a $10 billion exit in the future. In order to do that, if they were valued at the same valuation that Monday.com is, 12x enterprise value to revenue, that would mean they would be generating north of $800 million in revenue. And you really have to ask yourself, how long is it going to take them to get to a point where they're generating $800 million in revenue? And are there other investments that you could make that would generate a better return with less risk and in less time than this investment? At the end of the day, these are the kinds of things you need to be thinking about as you're evaluating investments. Oftentimes, it's the devil's in the details that can really trip you up into making a bad investment. At the end of the day, Airtable is a fantastic company. I love them. I think they're an awesome company. I love their product, and I hope that they stay around for a very long time because they add a lot of value to my life. That being said, you got to be really comfortable with the valuation risk that you would be taking on if you're going to invest in this company. Now, hopefully this was interesting and informational. None of this should be construed as investment advice. I'm not an investor in Airtable, and I'm not advocating that you invest or don't invest in the company. What I'm hoping is that you have a better understanding now of the importance of liquidation preferences, preference stacks, valuations, and how all of those things come together when evaluating a late stage investment so that you don't get caught up in the glamour that is an amazing company and that you're able to actually dig into the details and really understand the underlying risks that you're taking on when you make that investment. If you enjoyed this, please be sure to check out some of my other videos, especially those where I'm meeting with fantastic founders from companies that are raising on WeFunder, where you have an opportunity to evaluate the company for yourself and actually invest just like a shark if you are so inclined. Highly recommend the Painterland Sisters if you haven't checked out one of those. The founder there is phenomenal and a founder that I know you'll enjoy watching. Thanks so much.